Hello, and welcome to Credit Compass, your guide to navigating European credit markets. I have to admit, I'm going through a little bit of withdrawal at the moment. The wonderful 2 weeks of the Winter Olympics have come to an end. My country of birth, Canada, didn't quite deliver. Losing both ice hockey finals will, I suspect, leave the nation in a mild state of sporting depression. From my current home, the UK, results were respectable, and from a broader European perspective, it was an excellent games. Norway dominating as usual, and Italy not only hosting superbly, but also performing strongly. Now, much as I'd love to spend the entire episode breaking down alpine splits and biathlon drama, today we turn to something equally competitive: Europe's economic and investment outlook. All right, let's dig in. Let's start with growth. Germany posted 0.3% quarter-on-quarter GDP growth in the final quarter of 2025, slightly above expectations of 0.2%. That may not sound dramatic, but it matters. After a prolonged period of stagnation and industrial weakness driven by elevated energy costs, tariff pressures, and shifting trade dynamics with China, any positive surprise is meaningful. This is the long-awaited stabilisation that policymakers have been hoping for. The question now is whether this is a one-off bounce or the beginning of sustained momentum. The latest IFO Business Climate Survey provides cautious encouragement. Both assessments of current conditions and expectations improved, each rising by roughly 1 point after several months of stagnation. The present business situation index reached its highest level since 2024. Importantly, it remains below long-run averages, but directionally, it's moving the right way. Then we have factory orders. December orders rose 13% year-on-year and 7.8% month-on-month, a very strong print. However, as always, we need to unpack the composition. A significant portion of the increase was driven by large capital goods orders, including domestic government-related demand, specifically weapons, munitions, and industrial technology. That reflects both defense spending commitments and broader CapEx initiatives. Domestic demand was a key driver. This is a positive, but it is also somewhat concentrated. Large-ticket industrial orders can distort monthly data. Meanwhile, the auto sector, historically central to Germany's industrial base, remains subdued with slower momentum. So, we are seeing improvement, but it's uneven and still early cycle. That said, a substantial share of promised German fiscal spending has yet to filter through. As that capital begins to hit the real economy, early 2026 could show stronger flow-through. For Europe as a whole, a stabilizing Germany is critical. France continues to struggle to gain consistent traction, and Southern Europe, while more resilient, cannot carry the bloc alone. A firmer German core supports the entire European growth complex. This brings us to the EU Competitiveness Summit on the 12th of February. There was little dramatic headline news, partly because many of these themes are familiar, but what has changed is the tone. There is a growing sense of urgency. Leaders reiterated commitments to regulatory simplification, a recognition that cumulative compliance burdens have weighed on growth. One notable initiative is the proposed 28th regime, a harmonized corporate law framework allowing companies to operate across EU borders under a single set of rules. If implemented effectively, this could materially reduce friction for cross-border business. There was also unanimous support to accelerate the Savings and Investment Union. Some press coverage suggests an ambition to make substantial progress by year-end. If delivered, that would be a significant structural reform, deepening capital markets and improving the allocation of European savings into European productive investment. Energy prices were another focal point. Policymakers emphasized near-term pragmatic measures to reduce electricity costs while still maintaining the longer-term energy transition. Industrial competitiveness in Europe is directly tied to energy pricing, particularly versus the US and parts of Asia. Strategic industries and open trade were also highlighted, reinforcing the shift towards industrial policy thinking within Europe. To underline the urgency, French President Emmanuel Macron set the June Council meeting as a deadline to agree on a reform package. If consensus cannot be reached at 27, leaders floated the possibility of enhanced cooperation, where a subset of member states moves forward independently. We've seen this approach before. It was used to push through a 90 billion euro loan package for Ukraine without unanimous participation. In other words, the mechanism exists. The political question is whether it will be used more broadly. While policy announcements can feel incremental, there are tangible signs of movement. Banking consolidation has increased. Despite some high-profile cross-border deals being blocked, 2025 saw approximately 17 billion euros in cross-border European bank mergers, the highest level since 2008. That is notable. Europe has long struggled with fragmented banking markets. Larger, more competitive banking institutions could improve capital allocation efficiency and enhance global competitiveness relative to U.S. peers. Political sensitivities remain. Banking remains a national interest issue in many countries, but the trend towards consolidation is constructive. While policy announcements can feel incremental, there are tangible signs of movement. Banking consolidation has increased. Despite some high-profile cross-border deals being blocked, 2025 saw approximately 17 billion euros in cross-border European bank mergers, the highest level since 2008. That is notable. Europe has long struggled with fragmented banking markets. Larger, more competitive banking institutions could improve capital allocation efficiency and enhance global competitiveness relative to U.S. peers. Political sensitivities remain. Banking remains a national interest issue in many countries, but the trend towards consolidation is constructive. At the same time, the European Central Bank has taken a more technical but strategically important step. The ECB has expanded access to euro liquidity through repo lines for foreign central banks. A repo line allows a central bank to temporarily exchange high-quality collateral, typically speaking sovereign bonds, for liquidity in a specific currency. In this case, foreign monetary authorities can access euros directly from the ECB during periods of market stress. Why does this matter? Because reserve currency status depends not just on economic size, but on reliable liquidity infrastructure. The US dollar's dominance is reinforced by the Federal Reserve's extensive global swap and repo network. By broadening its own framework, the ECB is strengthening the euro's financial plumbing. This reduces the risk of euro funding stress outside the euro area and makes holding euro reserves more practical. If central banks know they can obtain euros during periods of dysfunction, the currency becomes more attractive as a reserve asset. This does not replace the dollar. U.S. capital markets remain deeper and more unified, but currency influence evolves gradually, built on institutional architecture. From a credit market perspective, this is supportive. Stronger liquidity backstops can reduce perceived funding risks, support euro-denominated issuance, and enhance confidence in the broader system. And that strengthening of financial infrastructure is happening alongside a shift in investor behavior. According to EPFR data, European equities are on track for what could be their largest monthly inflows on record in February. The first 2 weeks alone saw roughly $10 billion in weekly inflows as investors diversify away from relatively expensive U.S. markets and reassess concentration risk, particularly around AI-driven valuations. However, European equities are not cheap in absolute terms, but on a relative basis, valuation gaps have narrowed the discount. Combined with improving macro data and policy momentum, investors are reassessing the region. For credit markets, again, this matters. Equity inflows often precede broader capital market confidence. We are currently seeing a steady issuance pipeline across European corporate and securitized markets. Credit spreads have remained relatively stable despite equity volatility, suggesting underlying demand remains intact. If growth continues to firm and structural reforms gain credibility, spread compression could follow, though that remains conditional on global risk sentiment and arguably, given how tight spreads are already, more likely means just more support to avoid spread widening. So, let's bring this together. Europe does not move quickly. We've discussed that before. 27 countries negotiating policy changes guarantees complexity. But the external pressures Europe has faced Energy shocks, geopolitical tensions, trade fragmentation appear to have catalyzed something. There is a discernible shift from discussion towards implementation. The securitization framework is a good example. Policymakers now recognize that previous regulatory tightening may have gone too far. Proposed adjustments signal a pragmatic recalibration. The pendulum is swinging back toward balance. Growth expectations remain modest, below 2% in most forecasts, but direction matters more than level at turning points. After a prolonged stagnation narrative, we are seeing early stabilization in Germany, improving sentiment surveys, increased fiscal momentum, banking consolidation, and capital inflows. So, what does this mean for markets? Well, equity investors appear to be acknowledging the shift. Credit markets, for now, are reflecting steady demand and resilient spreads. The real test will be whether policy delivery matches rhetoric and whether growth momentum broadens beyond concentrated industrial orders. For the first time in a while, however, Europe's trajectory looks incrementally better, and in markets, incremental improvement often matters most. That's all for this week's edition of Credit Compass. If you found today's discussion insightful, please follow, rate, and share the show. It helps others discover it. For deeper insights and data-driven analysis on macro and credit trends, visit kbra.com/macrocredit. Until next time, stay curious, stay informed, and stay resilient. Let Credit Compass help guide your way.